The standard software playbook is breaking down. For a long time, the logic was simple. More growth meant a higher multiple. Two competing theories are currently driving this market tension. One side argues that traditional software companies are losing their competitive edge because AI makes it so easy to replicate complex features. In this view, the software moat is effectively evaporating. The other theory focuses on the burden of capital expenditure. It suggests the sheer cost of building AI infrastructure is creating a survival test that many legacy players may not pass. But spending levels alone don't explain why some high spenders are being rewarded while others are punished. This suggests the market is moving away from a single rulebook and is instead testing every business model against a new, unforgiving set of criteria. Prices are reacting to this deep uncertainty long before any actual financial damage shows up in the reports. Investors are focused on a central question. Who actually captures the value created by AI? Generating value is not the same as keeping it. To visualize the industry structure, think of a 4-story building. The foundation consists of infrastructure and computing power. Above that are the platforms, followed by applications, and finally the customer at the top. Currently, that foundational layer is absorbing the majority of early spending. But if the application layer cannot convert these costs into significantly higher revenue, the entire cycle could stall. This creates a clarity problem. When it is uncertain who will retain the economic gains, the market becomes volatile. Established players are seeing their advantages erode, while developers of new tools are growing nervous about the time required to see a real return on investment. This confidence bottleneck is a primary driver of the current repricing. Understanding how this uncertainty translates into stock prices usually comes down to 3 specific levers: cash flow durability, the risk premium, and time. Durability measures how stable future profit margins are likely to be, while the risk premium is the extra return investors demand to compensate for AI-driven unknowns. Time refers to the way payback periods for massive upfront investments are stretching further out. Even small shifts in these variables can have an outsized effect. For instance, a 1-point increase in the required investor return can cut a company's fair value by a mid-teen percentage. When you combine that with a delay in when profits actually start rolling in, the resulting price correction looks far more severe than what is visible in current earnings reports. The market isn't just reacting to heavy spending, it is factoring in a powerful compounding effect, where multiple uncertainties hit all at once. This framework explains why 2 companies with identical spending plans can see completely different market reactions. The total dollar amount often matters less than how clearly a company can define its path to a return. One critical but often quiet variable is capacity utilization. Large investments in data centers are viewed favorably if those servers are already active with paying customers. If the spending is primarily a speculative bet on future demand, it is seen as a major risk. Investors are now examining profit margins to judge whether the spending is truly efficient. A key sign of strength is a company's ability to maintain its pricing while delivering new AI value. Success depends on holding pricing power and deep customer relationships to capture that value. We are seeing a divergence because companies at different levels of the value stack have very different levels of control over their financial outcomes. The goal is to identify which companies can successfully transform AI utility into predictable cash flow. There is a compelling counter-argument that this might not be an AI paradox at all, but rather a result of broader macro factors like interest rates. It is possible that we shouldn't attribute every market shift to AI. However, the extreme variance between heavy spenders suggests that company-specific P&L pressures are the primary drivers. To test this, we should monitor whether infrastructure builders show clear progress in converting spending into unit economics. For software incumbents, the test is whether they can maintain pricing and retention as AI becomes a standard feature. If macro trends eventually explain most of the volatility, then the AI-specific narrative may be overblown. But current evidence suggests that how value is captured is the market's primary concern, independent of the broader economic environment. The tension today isn't about whether the technology works, but how we price its value. Based on frameworks used by Unity and others, we are tracking 3 specific signals. One is the margin trend among infrastructure builders to see if they are successfully monetizing record capital expenditure. We are also looking at pricing stability for software incumbents to see if traditional moats can withstand AI disruption. At the same time, we are looking for evidence of clear cash conversion and unit economics from new AI-native applications. These markers help determine if the market repricing is nearing an end or if more uncertainty lies ahead. This focus moves us away from headlines and toward the actual mechanisms driving the numbers. Fundamental drivers generally outlast the immediate news cycle. The market appears to be pricing in deep uncertainty rather than a final verdict. For self-directed investors, a patient, first principles approach remains a practical way to navigate these contradictions. You can find all sources and specific claims in the description. If this analysis of the underlying mechanisms was useful, consider subscribing for more deep dives into the software stack.